Over the weekend, it was announced that Silicon Valley Bank, the nation's 16th largest bank, had failed. And I received a lot of calls from some friends and some clients just asking me what happened and why this happened. So I thought I would just take a few minutes today to address who Silicon Valley Bank was, what caused this to happen, and how this might impact the broader economy. Silicon Valley Bank was founded in 1983 in San Jose, California. They referred to themselves as the financial partner of the innovation economy, and they were the only publicly traded bank that was focused solely on Silicon Valley and specifically new tech startups. When startups receive funding, they need somewhere to put that cash, and Silicon Valley Bank became the bank of choice for US tech startups. And according to their website, about 44% of US venture-backed tech and healthcare startups that went public last year use Silicon Valley Bank as their bank. Now, when banks receive deposits, they use these funds to make loans or to make other investments in order to make money. During 2020, Silicon Valley Bank's total deposits grew from about $62 billion to over $124 billion, and they use this influx of cash to make investments in long-term securities like treasury bonds and mortgage-backed securities. This was at a time when interest rates were at an all-time low. We know that bond prices and interest rates have an inverse relationship, so eventually when interest rates started to go back up, the value of the investments that SVB had made lost value. Now, this on its own is really not a huge concern, because if these bonds were held until maturity, they would get back all of the money that they used to purchase them. However, when a lot of customers started to request cash all at once, this forced SVB to sell these investments at large losses. The fact that SVB had made such long-term investments in such a low interest rate environment, which we're no longer in, began to spook customers and caused them to start withdrawing their account balances at a rapid pace. This ultimately caused the bank to become insolvent in a matter of a few days and led to the largest bank failure since 2008. In 1933, the Federal Deposit Insurance Corporation, or FDIC, was founded in order to maintain stability and public confidence in our nation's banking system. The FDIC insures deposits up to $250,000 per account type and per account owner. Unfortunately for SVB's clients, about 85% of the deposits at their bank was above this threshold, therefore not insured. So as of Friday, clients of SVB would only be getting back up to that $250,000 amount insured under FDIC. However, over the weekend, the federal government stepped in to ensure that all account balances would be available come the open of business on Monday. It's important to note that this is not a bailout like we saw in 2008, because this is not being funded by taxpayer dollars. This is going to be funded solely through the FDIC. It's also important to note that this does not protect the shareholders of SVB, as the share price has now gone to zero. The government has stepped in quickly to show stability in our banking system and to keep fear from spreading to customers of other banks. Silicon Valley Bank was unique in regards to the customers that they served, and also the fact that these customers were highly correlated to each other. It seems likely that credit conditions will tighten as banks move to protect their balance sheets. This will mostly surround the tech and venture capital world rather than the average consumer. In my talks with clients and friends over the weekend, the common theme has been, what does this mean for me and how can I protect myself moving forward? And I think that this is really important, especially in the rising interest rate environment that we're in. It's becoming increasingly appealing to keep more cash on hand, but I think we need to learn from this and make sure that we are protecting ourselves by keeping our account balances under that $250,000 FDIC threshold. There are some strategies that we can use to do this without having to go open accounts at multiple banks. We can focus on utilizing different registrations like single, joint, and trust registrations, but each of these decisions can have their own implications, especially when it comes to estate planning. So as always, it's important to consult with your financial advisor on how these decisions will impact your specific situation. If you have any further questions, feel free to reach out to us, and we'd be happy to speak with you about your specific situation.